feel like this year has been the bizarro world version of the prior sort of 10 or 12 years. And I think that juxtaposition is an interesting place to start, right? So I thought it'd be kind of fun to maybe get your take on how you characterize the market and the economic environment from kind of like 2009 to call it end of 2021. If you want, you can kind of end of 2019 pre-pandemic, and maybe the pandemic era is kind of its own regime. But maybe let's take that. What did that look like? What were the drivers? What lessons did investors learn from that? And then let's juxtapose what we're currently facing on that experience. How does that sound like a good place to start?
Sure, that sounds really reasonable. So, I mean, look, I agree with you that this year has felt like bizarro world in the context of what we've seen over the last decade, right? And more to the point, I think the thing that I'm most distressed by this year, like what feels most bizarro to me, is the apparent glee that people have about an interventionist Fed when it's hiking rates versus an interventionist Fed when it's cutting rates, right? And I genuinely struggle with this. I don't entirely understand why people who seem to be very much against an interventionist Fed that seems to be working without a functioning model of how money interacts in the banking system, how the banking system itself interacts with the real economy, the financial markets interact with the real economy. I struggle with how they've suddenly become so enthusiastic and have so deeply embraced this idea. Well, obviously, this is the right thing to do. That,
can I throw a thesis out?
What's that?
Can I offer a thesis?
Sure, please.
So, do you think that there's an increasing, and this cohort has increased over time, over the last decade especially? But I would argue that this has been going on longer than just the last decade. But I definitely think it's accelerated, been taken to a new level. I think there's an increasing number of people who really felt left behind by the interventionist easy Fed, right? The fact that the Fed had intervened since 2009 consistently to bail out speculators, to incentivize risky behavior or bad behavior, had amped up moral hazard, and in so doing had left an increasing proportion of people out of the wealth generating functions of, and especially of the U.S. economy, and one might argue other developed economies, more so through the housing channel than through the equity and bond channel, maybe. But if there was a feeling that lower rates and rewarding risky behavior and all of those other dynamics that were that sort of went along with an interventionist Fed from the 2009 to 2021 period caused people to feel left out, maybe there's a feeling that finally we're unwinding some of those dynamics, and there's a possibility, without having to resort to the kind of nihilistic behavior that we observed, especially that sort of really ramped up in 2021 with the GameStops and the crypto and the hyper speculation in the options markets, et cetera, without having to resort to those types of nihilistic behavior. That this kind of dynamic now is equalizing the boat a little bit, right? And so let me just throw that out there and get your reaction on that as a potential source of explanation.
So I definitely think that there is an element that people want to believe that, right? That there is. I might put it slightly deeper into the psyche and say that Americans, as a country, broadly embrace the German puritanical component of suffering for your sins, right? So I think oddly we tend to enjoy punishment more than we enjoy reward. We constantly feel with reward that there's going to be something coming on the other side. And I guess I would push back pretty hard against the idea of the excessive speculation having been squashed, particularly in the option space, as we're now seeing roughly roughly 50% of all option transactions are now happening within less than a week to expiry options, right? These are functionally, as I've described it in my Twitter feed and various other things, like this is, okay, put it on black, right?
Yeah, just as a side note, Jem Karzan was our guest last week, and he was speaking precisely to this point, that the amount of options that have been traded by retail, and specifically in the run-up to their expiry, has thrown such a curveball to market makers, then it's added to the complexity of the dynamics that we see nowadays in the lack of signaling mechanism in the equity market.
Yeah, no, I think that's exactly right. So I think you guys know this. I write a newsletter for Tier 1 Alpha that is another one of the businesses I'm involved with on this dynamic of option theory. And we're talking exactly about this, right? So we've started to develop some tools that allow us to think about this, but this phenomenon has emerged in such a novel form in such a short period of time that it has substantively changed the game, in the same way that I would argue the meme stock behavior took short sellers by surprise, right? Now, I mean, we've always seen components of this type of speculation before, but, I pointed this out yesterday on Tuesday, I think it was, with the Fed, where, I went on Wednesday, I'm sorry, where if you had bought at the open a, zero data expiry call and then flipped it upon the release into a zero, data expiry put, you would have made something like 30 times your money over the course of the day, right? If, on the other hand, you had actually transacted in those options for a 2-day period, right, you would have lost money. So, I mean, it was just like absolute rank speculation, true path dependency, no real opportunity for a meaningful investment framework. And yet all the dynamics that we know that individuals like Ben Eifert and others have done such an excellent job, Jem, et cetera, have done such an excellent job of describing the need for the delta hedging and how this plays out in increasingly thin and illiquid markets. All of that has now basically been short-circuited because zero data expiry options are pure gamma. I mean, they are just pure gamma. They're either, and just again, to define this, I've tried to help people think through these components. Remember what gamma is. It's the change in delta per unit of change in price, right? And so if you think about a zero data expiry option, it has one of two states, alive or dead, right? And alive, it's 1 delta, dead, it's 0 delta. And so every change that happens in that option is pure gamma, change in delta for change in price. There's very little time value component to it other than, just purely evaporating component, et cetera. So in every theoretical model we've ever had, the zero data expiry option has been a sale. Now suddenly it's there's extraordinary temptation to carry it to expiry. And we're seeing the exact same behavior, by the way, that we saw in the meme stocks and the options associated with the meme stocks, where the market makers are cranking the price of these up, right? So historically, a zero data expiry option will carry an element of implied volatility that reflects some jump to default risk. But generally, if you're transacting within 1 week of expiry, those options are going to trade at a discount to the VIX, which in turn is going to trade at a discount to longer dated. The vol surface tends to be upward sloping. Now we've got a vol surface that up into the last week basically spikes, right? So we're now carrying a significant premium in those last 5 days, in part because market makers know that they can extract it from individuals who are gambling, right? I mean, they don't actually care. They just want to try and make that 30-to-1 payout, right? Somebody made money on, again, like I walked through this, somebody transacted, somebody made money, but it was actually not 30-to-1. They made basically 2-to-1 on their money, sort of thing. It's like, guys, that's a terrible trade. If you're trading a 1-day option and you make 2x your money over the, and it's 50-50, like over the course of the year, you're going to lose all your money, right? You don't even need a year, right? I mean, I don't care what your betting frequency is or anything else. Like, that's just a bad trade. I almost will never enter into an option unless I have a reasonable expectation of payout on success of 4 to 5 to 1, precisely because it has such low, a long option position, precisely because it has such low payout probability in terms of its maximum expression, right? So I don't think we've actually killed the speculative component. If anything, I think we've amped up the nihilism, where people are increasingly just saying something along the lines of, I'm happy to go down as long as everybody else gets hurt too.